Welcome back. I thought it might be helpful to take a look back at some of the economic numbers. We've seen quite a bit past the tape over the past week or so, including non-farm payrolls. Last week you had the PCE, personal consumption expenditure, and this morning the CPI, consumer price index. The charts depicted below in red indicate a current downtrend, or at least a turn down in the past few reports. Those in green indicate an overall trend to the upside. And we can see the vast majority of these economic charts do show the macroeconomic numbers are heading lower. Home price index, sales price, existing homes is trending lower. The PCE is moving higher, but again, because that's an inflationary number, that's actually a negative towards the economy. Existing home sales is heading lower. Housing inventory, which is the number of homes on the market, is rising, and that's actually considered to be a negative as it reflects a weaker demand for homes. Consumer price index was reported a little bit less than expected. However, it is still trending higher at the moment. Advanced retail sales does look good. That perhaps is reflecting in part seasonal factors. Industrial production's a little bit weak. Non-farm payrolls trending lower. Unemployment rates really kind of flat. 30-year mortgage rates continue to decline. The real bright spots here are the durable goods, business inventories, the active listings for homes, manufacturing inventories. Indeed, job postings also are rising as well. But aside from that, for the most part, we do see declining economic figures across the board. Today's bond market, we see rising yields on the longer term bonds. The 7, 10, 20-year bonds are moving higher. Not so much for the 1 and 2-year bonds. The stock market's up pretty significantly today. So we can see the capital is really moving out of the long-term bonds. And this is a real change from what we've seen over the past few months, where usually the shorter-term bonds, like the 1 and 2-year bonds, have really showed us the greatest amount of growth in terms of yields. Taking a look at the red line, top right-hand corner, that shows us the total bond yields. The blue line represents the S&P 500, and we can see as the anticipation of higher interest rates continues to really hover above us, we tend to see higher bond yields across the board. However, that has waived to some extent, at least as of late. Bottom center chart, the green line represents the total bond spreads, the spread between the 30 and 10-year bond, the 10 and 7, etc. We see that has really fallen very dramatically over the recent past couple of weeks, especially the past couple of weeks, but even longer than that, the past couple of months. And that really reflects the compression in the bond yields, the inverted bond yield markets. Now we see here the 10-year bond currently pays 114 basis points less than the 1-year bond. The 10-year bond is at a 361. The 1-year bond's at a 475. But take a look at the 6-month bond. The highest yield is now at the 6-month bond. Now, going back several months, we saw that the higher yielding bonds were the 1, 2, 5-year bonds, but we can see that traders are now selling the shortest term bonds, or close to the shortest term bonds, the 6-month bonds. And that's telling us that in the immediate future, traders are really selling the near-term bonds, expecting perhaps a near-term downturn in the markets. The gray histogram bars show us the 30-day rate of change. And we see the strongest markets out there have been some of the energy markets, such as kerosene, diesel, and heating oil. Some of the weakest markets have been the Nasdaq Volatility and VIX Volatility Index. Those are typically hedges towards equity markets. So as equity markets have been strong, these have definitely been the weak side of the markets. Top left-hand corner shows us 500 dots. Every dot represents one component in the S&P 500. The vast majority of the stocks have an RSI, a relative strength index reading between 45 to 65, right in the center. However, we look at the top right-hand side, we see this is an RSI count, the number of stocks with an RSI in any particular area, and we can see this with greater detail. The vast majority of the stocks in the S&P 500 have a relative strength at 55, especially 60 and 65. So we see a general trend to the upside in the markets, at least in terms of the RSI. That's a more immediate indicator. Bottom left-hand corner shows us the same 500 stocks, but in terms of their own respective 52-week range, and it's really spread out across the board. We have just about an equal amount of stocks near the lower end of the 52-week ranges as the upper end of the 52-week ranges. And the right-hand side shows us in terms of the histogram bars, the number of stocks at any particular 52-week range count. And it really is telling us this compared to the RSI, that in the immediate past, the stock market has been very strong, but overall, we're actually right in the middle. And it really is, as they say, a stock picker's market. Some stocks are very strong, some stocks are very weak. It really comes down to sector rotation. Taking a look at some of the indices, now this is a relative strength index of the individual sectors within the S&P 500. The strongest sectors are healthcare, utilities, the Philadelphia Utility Index. There's a gold miners index, consumer staples. Those have been strong. The weakest sectors have been lately energy, consumer discretionary, 10-year bond, the NASDAQ bank index, and everything else is really towards the middle. It's a very equally dispersed or distributed stock market. The sectors, in terms of their own respective 52-week range, is a little bit more specific in their divergence. The top sectors include healthcare, energy, Philadelphia Oil Service Index. We know the energy sectors have been strong. Select Spider Trust, the 10-year Treasury Index, and NASDAQ Biotech Index. The weakest indices have been the QQQ, which is primarily technology, NASDAQ Computer Index, NASDAQ 100 Index, NASDAQ Bank Index. So we have a lot of technology representing the weaker stocks in the range. The strongest stocks, again, are energy, healthcare, Philly Oil Service Index, that sort of thing. And we also have here, this is a pretty neat comparison. The red line represents a non-farm payrolls. We know the most recent report showed a 263,000 gain. The purple line represents Indeed job postings, a number of postings on the Indeed employment website every single day. And we can see overall there's a pretty strong correlation. As the Indeed number goes down, so do non-farm payrolls. The non-farm payrolls only obviously updated once a month. The Indeed job postings are updated daily. And then when both lines move up and both lines move really down together as well. However, we see as of late, there really has been a lot of strength in the Indeed job postings. So it'll be interesting to see if the non-farm payrolls, which is more of a lagging indicator, if that shows us better than expected numbers in the next month. It'll be very interesting to see. Finally, left-hand side of the chart, the red line represents the mortgage rates. The blue line represents a 10-year Treasury bond. If you divide the two, meaning the mortgage rates divided by the 10-year Treasury, that gives us a mortgage spread. And typically, the mortgage spread, by the way, is the yellow line on the right-hand side charts. Now, typically in weak markets, when there's not a lot of demand, we see the mortgage spread declines, meaning that the mortgage rates decline below the 10-year bonds, or they stay above, but above to a lesser extent, I should say. The purple line here represents the S&P 500. And we've had a pretty strong correlation. S&P 500 goes down, the mortgage spread goes down. S&P 500 goes up, the mortgage spread goes up. But notice the mortgage spread's not really reacting to the S&P 500. So the S&P 500 is moving up. It's leaving the mortgage spread behind. Perhaps that indicates that we see underlying weakness in the housing market, and the S&P 500 is trending higher as a result of energy and healthcare and biotech and some of those other stronger sectors out there. So we see a little bit of a divergence here. But overall, again, to recap, we see the vast majority of the sectors, I should say the economic numbers, show us rather weak conditions. New York Empire, manufacturing, the construction spending is weakening as well. Trade balance, University of Michigan's flat, but not really that great either. So the vast majority of these sectors, or I should say these economic numbers, are weak. The wealth around the S&P 500 is spread pretty equidistantly. However, definitely a lot more strength in the oil and consumer staples and defensive stocks, which typically I don't know that is necessarily a good sign. If we see technology stocks, lead the way, I would say that's signs of a stronger economic economy or an economic condition, I should say. But overall, it looks like the market is taking optimistic but defensive position. So it'll be very interesting to see how this plays out in the next pending Federal Reserve meeting. We hope this has been helpful. We look forward to seeing you back soon.